I'm going to cover life assurance contracts from the topic of contingencies in actuarial science in two parts. So this first part is going to cover all the formulae that you need to know to write the exam with benefits that are payable at the end of the year of death, and the second part is going to be to do with the life assurance contracts where the benefits are payable immediately on death. Okay, so let's start with a whole life assurance contract. So this is a whole life assurance, and this is going to be where the death benefit is payable at the end of the year of death whenever the person dies. So the person doesn't have to die within a particular time period. It's whenever this person eventually dies, the death benefit will be payable at the end of the year of death. And typically the premiums for this type of contract are payable in advance yearly, so per annum payments, and we're going to cover that in the subsequent sections, which is life annuity contracts. So you'll need to use a life annuity contract in order to price a life assurance contract so that you can calculate the premium. So the life assurance contract deals with the lump sum that's payable on death, and the life annuity contract then would deal with either benefits paid out until someone dies or premiums that an individual must pay until they die in order to receive the lump sum death benefit. Okay, so this first one we're talking about a whole life assurance contract. So this pays out, it's guaranteed to pay out because the person is eventually guaranteed to die. Okay, and when they do eventually die, in this year of death, at the end of that year in which they die, they'll be paid. So the random variable for the present value of this is going to be v to the k x plus 1. Okay, if you watch the previous video on the life table, you'll notice that kx is the random variable for curtate future lifetime, which means the number of whole years left of life that a person has left. So if someone dies in 10.5 years time, so 10 and a half years time, we say that their curtate future lifetime, kx, a life aged x, is 10, okay, because we round down 10 and a half to 10. And now if that's payable at the end of the year of death, then I must present value this lump sum by 11 years. So kx will be 10, and then 10 plus 1 is 11, even though they died 10 and a half years into the future, okay? And then v is just 1 plus I to the negative 1, but you should know that by now if you're doing this course, okay? And if you don't know that, then I suggest you look at my financial maths videos. Okay, so v to the kx plus 1 is going to be the random variable representing the present value of a whole life assurance contract. Now, if we take the expectation of this random variable, this gives us the expected value of this whole life assurance contract. Expected present value. It's already present value here, but when I take this expected, it becomes expected present value. Okay, so what's the formula for this? So it's the sum to infinity from k equals 0 of v to the k plus 1 times by the probability that kx equals k. Okay, so let's understand this. So what I'm essentially saying here by summing from k equals 0 to infinity is I'm taking for any value of kx, it can be any value between 0 and infinity. So this person can die in 0 whole years time, so they can have 0 whole years of life left, or they can have an infinite number of whole years of life left. Obviously that's not practical, but the probability for such large future lifetimes will be negligibly small. So we still take the sum to infinity. Okay, so if someone dies in 6 months' time, then k would be equal to 0 because their curtate future lifetime is 0 years. And then they would be discounted, this present value would be discounted, the lump sum would be discounted by 1 year, so 0 plus 1. So it's v to the power of 1, and I multiply that by the probability that they have 0 years left, that their curtate future lifetime is equal to 0. Okay, And I sum that up from 0 to infinity. So if someone dies in 5.5 years' time, that's 5.5 is the future lifetime of this person, but the curtailed future lifetime is going to just be 5 years. So then I'll have 5 plus 1, 6. So I'll be discounting the lump sum by 6 years, and the probability will be the probability that their curtailed future lifetime is equal to 5 years, given that they die in this 6th year. Okay, 5.5 years is in the 6th year. Okay, so the curtailed future lifetime must be equal to 5. They die between 5 and 6 years from now. Okay, now another way to write this probability here is by saying the deferred probability, KQX. So this means that a life aged X dies within a year after K years from now. So they die aged X plus K. Okay, so that's the formula, and the symbol for this that we use is capital A with a subscript X. Okay, and I'll explain this notation a little bit more as I go, but capital A's refer to assurances and lowercase a's will refer to annuities. Okay, and then this X represents the age of the life that's taking out this policy now. Okay, so that's the expected present value. But what about the variance of this random variable present value for whole life assurance contract? Well, that's going to be the variance of v to the kx plus 1. Now, we know that the variance of any random variable x is going to be equal to the expectation of x squared minus the expectation of x all squared. Okay, so applying that logic to this, we must then take the expectation of this squared. So what is that? So let me do that down here. So I'm trying to do the expectation of v to the kx plus 1 squared. I'm trying to do that. But I can multiply the exponents. Okay, so I distribute that 2 in there. And it looks something like that. But that's just the same thing as raising v to the power of 2 to the power of kx plus 1. Okay, so what I've essentially done then is I've just changed the interest rate. So if v is equal to e to the negative delta, where delta is the force of interest, then v squared is equal to e to the negative 2 delta. So v squared is calculated at double the force of interest that v is calculated at. Okay, and then this is just then the same thing as this line, except with a different force of interest. So I'm going to label that AX with a superscript on the left-hand side 2. Okay, and this just represents double the force of interest, or since V is equal to 1 plus I to the negative 1, and I take V squared is equal to 1 plus I to the negative 2, then this V here, I end up simplifying this, and I get that this new interest rate that I'm using in this is equal to, so I star being the new interest rate is equal to 1 plus I squared minus 1. Okay, and I'll explain how I got that. So basically now, V squared must be equal to V new with a star. Okay, so V squared is going to be at the old interest rate, 1 plus I to the negative 1, and V with a star is going to be, and sorry, that's to the negative 2 because of that 2 there. V star is just going to be 1 plus I star to the negative 1. Okay, so I can raise both of these to the negative 1, and I get that this is to the positive 2 and that's to the positive 1. And then I can just subtract that 1 from both sides, and I end up at this equation here. Okay, so double the force of interest will be this first expectation. So remember now, what we're trying to do is this variance, and I've just done the expectation of this present value inside this variance squared. So here, and I get 2ax. So I'm going to say here 2ax, and then minus the expectation. So from this, I must minus the expectation of vkx plus 1, and this expectation squared. But I calculated this expectation here to be capital AX, just a whole life assurance contract. So now I take this whole life assurance contract and square it. Okay, so that's the derivation, how we get to this over here. Alright, so that's whole life assurance contracts. Now let's move on to term assurance contracts. Change the color here, so we'll go term assurances. Okay, so now I'm going to let this random variable be called f, and then f is going to be equal to the present value v to the kx plus 1 or 0, and it's going to be equal to v to the kx plus 1 when kx is less than n, or it's going to be 0 when kx is greater than or equal to n. So let's first understand what a term assurance contract is, and then we can try and understand why this must be true. Okay, so a term assurance contract is exactly like a whole life assurance contract, except I'm only going to pay out to this person if they die within n years. So if they die within the next n years, I'm going to pay. If they die in n.5 years time, I'm not going to pay them. If they die in exactly n years time, I'm still not going to pay them, which is why the equality sign is for this 0. They're going to get 0 when their curtate future lifetime is equal to n. Okay. Alright, so that's simple enough. Now let's deal with this here. So if they die within n years, it means that their curtate future lifetime must be less than, strictly less than n. So if they die, if n is equal to 10, so they must die within the next 10 years, and they die in 9.5 years time, then their curtate future lifetime when they were aged x would have been 9 years. And if their curtate future lifetime aged x was 9 years, it means they're going to be paid at the end of that year, so 10 years later from now. So this will be 9 plus 1, which is 10, and I present value that, which is the same logic that we applied over here. Okay, now if I take the expectation of this random variable f, then in actuarial notation, this will be ax n with a line on top of the x. So what this essentially means is capital A for an assurance contract, x for the life now aged x, and this n for the term of n. And I put this line on top of the x to show that they will only get paid out if they die within n years. So once their lifetime from now exceeds n years, I'm no longer going to pay them. Okay, so I've got the line on top there to denote that it's a term assurance contract. I only pay them on death during the term. And the formula for this is equal to the sum from k equals 0 to n minus 1, where v of v to the k plus 1, k deferred, qx. Okay, and notice the similarities between this contract over here. What's inside the summation is exactly the same, so I'm not going to repeat that understanding because you should know that based off what I've explained over here. And then this k equals 0 is this for the same reason that this k was equal to 0. Now the only thing that's changed is instead of infinity, we have n minus 1. So why is that? Well, once their curtate future lifetime exceeds or equals n, I'm no longer going to pay them. So I don't include it for values that are greater than n. So I only include it up until n minus 1. Why n minus 1, you may ask? Well, if it equals to n, then I'm essentially saying in here, v to the n minus 1 plus 1, which is v to the n. So that means that they can die with their curtailed future lifetime being equal to n, and I'll still pay them, which is not the case. That's outside the term of the contract. So I must end it at n minus 1 over here. And you can also see that from the support over here of this random variable. This v to the kx plus 1 is defined when kx is strictly less than n, and kx takes on integer values. So the number that's strictly less than n is n minus 1, so this sums up to n minus 1. Okay, so what's the variance for this? So the variance for this random variable, variance of f, is going to be equal to 2ax n minus ax n squared. And the same logic can be applied to get this, that I applied to get this. Alright, so let's move along then to pure endowment contracts. So pure endowments. So a pure endowment is much more like an investment plan that's contingent on the person surviving until the end of the term. So if the person survives until the end of the term of this pure endowment, then they will receive a lump sum in return. Okay, and obviously if they die during the term, then they're going to get nothing. So let's represent this with random variables, present value random variables. So I'm going to let this random variable be g for the present value of a pure endowment contract. Note I said present value, not expected present value. I only get the expected present value once I take the expectation of the present value random variables, as I've done for term assurance contracts and for whole life assurance contracts. Okay, so pure endowments, g is going to be equal to 0 when kx is less than n, or v to the n when kx is greater than or equal to n. Okay, so how does this differ from a term assurance contract? Well, when kx was less than n, it means that the person died within n years, and it means I'm going to pay them, so I'm present valuing that. But now I'm saying that when this person dies within n years, I'm not going to pay them. I'm going to give them nothing. But if they survive to the end of n years, then I'm going to pay them, and I'm going to discount it by the term. So if they survive for n years, then I pay them at the end. But in term assurance contracts, if they are still alive at the end of n years, I'm not paying them anything. Okay, so term assurance contracts protects the policyholder's family members for the risk that their supporter dies within the term of the contract. A pure endowment would, for example, be insurance for someone who is concerned that if they live to a certain age, they might run out of money. Okay, and if they do live to that certain age, they're going to want a lump sum of money. So a pure endowment contract is much like a savings vehicle. If this person does live, they're going to need money to support themselves. And so if they survive, then they get the benefit of this contract. Okay, now, so I've explained this. Now let's take the expectation and see what we get here. So the expectation of this random variable g is going to be equal to, in actuarial notation, it's a x n with the line on top of the n this time. Okay, so the difference here between a term assurance contract and a pure endowment contract, they both are assurances and hence get capital A's. They both are for a life now aged X. They both have a term of n years. The difference is when they pay. So this one pays on the death of the life, so the line goes on the X, and this one pays on the survival to n, to X plus n, and so the line goes on top of the n. So this line represents when n is the cause of the ending of this contract. So in other words, the person lives to n before they die. Age x plus n before they die. They live n years before they die, and hence this must be the ending of the contract. In this case, the person's death must be the ending of the contract. They die before n years are over. Okay, so pure endowment contracts, what is this in terms of present values and probabilities? Well, this will be v to the n npx. Why is that so? Well, if they survive until the end of n years, then I'm going to pay them money, and I must discount that money by n years time, that lump sum to the present value. So v to the power of n, which comes from here. Now, they will only get paid if they survive. So I use npx as the survival probability for a life aged x for n years time. So a life aged x surviving n years, the probability of that happening is npx. Alright, so the variance for this type of contract, the variance of this random variable, is going to be 2ax n minus ax n squared. Okay, and much like the previous methods, you can derive this in the same way. And also note that this 2 superscript on the left-hand side represents this assurance contract at double the force of interest. And this 2 here just represents squaring that assurance, that pure endowment contract. And sorry, this should be a line on top of the n there. Okay, so what's the next contract we're going to deal with? So this is an endowment assurance contract. And this is not any more difficult to understand than the previous 2, just because it is actually the sum of the previous 2. So the random variable here, h, I'm going to define it to be h, is going to be equal to f plus g. So I used f for a term assurance contract, and I used g for pure endowment contract. So the sum of a pure endowment and a term assurance contract, that will be an endowment assurance contract. So this pays when the person dies within n years at the end of the year of death, or it pays if they survive until the end of the n years, until the end of the contract. So this equals when kx is less than n, it equals to v to the kx plus 1. And when kx is greater than or equal to n, it equals to v to the power of n. So how did I get that? Well, when kx was less than n, g was equal to 0, and f was equal to k to the x plus 1. And so 0 plus v to the k to the x plus 1 is just equal to v to the k to kx plus 1. Okay, then when kx is greater than or equal to n, I just get vn, because when kx was greater than or equal to n here and here, I had 0 plus v to the power of n. Alright, now in terms of actuarial notation, the expectation of h is going to be axn with no lines on top. Okay, so this equals to ax in a term assurance contract plus ax in a pure endowment, and that equals an endowment contract. Now what's the variance here? So the variance of h is going to be 2ax n minus ax n squared. Okay, and note that this is not equal to the variance, I'll use this for continuity, the variance of f plus the variance of g. And why would it not be equal to? Why would it not be equal to that? Because of covariance. So the variance of h must be equal to the variance of f plus g. Now the variance of f plus g would be equal to the variance of f plus the variance of G plus 2 times the covariance of F and G. And clearly, this covariance for the same person must be non-zero. And the reason for that is because if this person survives to the end of the contract, it means that they haven't died. So if you know that they've survived, then you know that the term assurance contract wouldn't have been paid, and vice versa. Okay, so the covariance is non-zero. But for 2 independent lives, this covariance may well be 0. And the reason for that is because the lives are independent. So there's no covariability in that. There's no covariance. Okay, but be careful there with the wording of the question and how they set it up. You've got to look out for independence of lives. If it's talking about one individual life, then you assume those lives to not be independent because it's the same life. Okay, so let's move on here to deferred assurance contracts. So I'm talking now about deferred assurances. Okay, so deferred assurances, I can get deferred whole life assurances, I can get deferred term assurances, and you obviously cannot get a deferred pure endowment because then it's just simply a pure endowment with a greater term. So there's no such thing as a deferred pure endowment. But deferred whole life assurances and deferred term assurances do exist. And so you can also get a deferred endowment assurance. But note, the pure endowment is not really deferred. Okay, so deferred assurances, let's talk about deferred whole life. And this is going to be, I'm going to use the random variable j, and it will be 0 when kx is less than n, or it will be v to the kx plus 1 when kx is greater than or equal to n. Okay, so what I've essentially done now with the deferred whole life assurance contract is I'm saying that if the person dies within n years, I'm not paying them anything. But when they die after n years, no matter how long after n years, I will pay them. So I'm going to discount that by their curtate future lifetime plus 1. Okay, so that's the present value of the random variable for a deferred whole life assurance contract. Now, in actuarial notation, the expectation of j will be equal to NAX. So I take this whole life assurance contract and I defer it by n years. That's what this n bar symbolizes. And this also equals to AX minus AX n. Now this AX is a whole life assurance contract, not deferred, and this AX n is a term assurance contract. So when I take a whole life contract for someone now aged X, and here they're aged X plus N, this is a whole life. This line here represents AX, and then this line here represents AX N, the term assurance, and then this line will represent AX deferred by N. So when I take a whole life and I take away the chance of them dying within n years, I don't take away the chance of them dying, but I take away the payment on a death within n years, I'm left with a deferred whole life assurance contract. So just the tail end of this whole life contract once I've subtracted that term assurance. Okay. So this will be equal to v to the n npx a x plus n. So what does that mean? That means that, going back to my timeline, someone aged x here, someone aged x plus n here, I'm taking that this life aged X survives to that point. I then give them a whole life assurance contract for the rest of their life once they've arrived at X plus N. So first they must arrive there, which means that they must live to that point, which means I must take into account the probability NPX. They must survive. A life age X must survive for N years. And then I discount that by N years. So I'm discounting here in terms of time and discounting here in terms of probability. And then what I'm left with is the whole life from X plus N onwards, which is a whole life assurance for a life aged X plus N. Okay. Now a deferred term assurance. Okay, let's actually do the variance here first. Okay, so the variance of J is going to be equal to the variance of, I'm going to say X minus Y. So X would represent the random variable for the present value of a whole life assurance, aged X, and Y would be the present value for the random variable of a term assurance for N years for life now aged X. Okay, so the variance of X minus Y is going to be equal to the variance of X plus the variance of Y minus 2 times by the covariance of X and Y. Okay, and if I expand this out, the variance of X, I know this is going to be, it's the variance of the same present value random variable that gave this expectation. So that's 2ax minus ax squared. Okay, and the variance of Y is going to be the variance of the present value random variable that gave this expectation, and that's going to be plus 2ax n minus ax term assurance n squared. And now I need to take into account this covariance. So from here I'm subtracting 2 into, okay, now the covariance of X plus Y, it's a formula that you're going to need to know now. So this is the expectation of xy minus the expectation of X times by the expectation of Y. Okay, so the expectation of xy is going to be equal to 2ax n minus, and then the expectation of X times by the expectation of Y. That's simply going to be that, ax times by that. So I'll have ax n, and now let me explain how I got this here. Okay, so the random variable X is going to be then v to the kx plus 1, given that they die at any point. And now y, so y was then the term assurance present value random variable, which comes from here. So it's going to be equal to this. So v to the kx plus 1 when kx is less than n, and 0 when kx is greater than or equal to n. So if I multiply these two, what I essentially get, so x times by y, v to the kx plus 1 times by v to the kx plus 1 when kx is less than n is going to be v squared to the kx plus 1 when kx is less than n. And then when kx is greater than or equal to n, I'm going to multiply 0 with this, which will just be 0. Kx greater than or equal to n. Okay, and then if I take the expectation of xy, which I've done here, the expectation of this is just going to be a term assurance contract at double the force of interest. Okay, so that's how I get that there. Alright, now you can simplify this, and this is tedious, so I'm not going to go through this with you. You can prove it yourself. It equals this here. So in essence, it comes very similarly to what we've experienced in the past with the variances, where if this is my contract, my expectation, then I just take the expectation at double the force of interest minus that expectation squared is going to be my variance, but except here it's arrived at through a slightly more complicated route because of this covariance that becomes involved. Okay, and then make sure to convince yourself how that's true. All right. So now we're going to talk about a deferred term assurance. So I've just talked about a deferred whole life. Now I'm talking about a deferred term assurance. Okay, so this is the last thing I'm going to do before I end this video, and then the next video I'm going to do on benefits that are payable immediately on death. Okay, so let's get through this. So now I'm going to use the random variable for the present value of a deferred term assurance is going to be m, and then I'm going to have 0 when kx is less than m, or when kx is greater than or equal to m plus n, and I'm going to go through this understanding in a moment. And then I'm going to have v to the kx plus 1 when m is less than or equal to kx is less than m plus n. Okay, so why does this work? What is going on here? So let's draw a timeline to understand this. So right now the life is aged x. I'm saying that when this life dies within m years, so when they're aged x plus m, they're going to get nothing. So 0 payment there. Okay, so I'll put a cross there. And then when kx, when their curtate future lifetime is greater than or equal to m plus n, so when their age is x plus m plus n, greater than that, so in that period, I'm also not going to pay them. They're going to get 0. So I'll put a cross there. But when their curtate future lifetime sits between m and m plus n, in other words, they die between the ages of x plus m and x plus m plus n, then I will pay them. So I have a tick in here. So this is what a deferred term assurance contract means. I'm receiving insurance, lump sum insurance, for this time period, death during this time period. And I'm using all of these because kx is curtate future lifetime, because I'm still dealing with death benefits at the end of the year of death. So in the next video, I'm dealing with benefits payable immediately on death, and then you'll see that I no longer use kx, I use tx. Okay, which would be the complete future lifetime, but here I'm using curtate future lifetime. Okay, so that makes sense. Now let's move on to write this expectation. So the expectation of m will be equal to m deferred ax n in actuarial notation. So we've seen all of these notational things so far in the video. Capital A, because I'm dealing with an assurance contract. X, because the life is now aged X and it's contingent on life, this benefit. N, because the term of this contract is n years. The active term, when they can get paid, so between x plus m and x plus m plus n is n years. And I'm going to defer this term assurance by m years. So the term assurance will only come into force after they're aged x plus m. So the n years happens after m years. Okay. So this then, and sorry, I've got a line on top of this x because it pays out on the death of the life of x within the term. Okay, so when the death happens before the end of the term, they get paid. All right, so I've spoken about all the notational things in that formula. Now this equals to ax, a term assurance for m plus n years, minus a term assurance for m years. Try and convince yourself that this is true before I explain it to you. So I'll explain it now. So this term assurance is for a life aged X, and it covers them until they're aged X plus S, M plus N. So in other words, this time period. Now, this term assurance just covers them until they're aged X plus M. Now, their cover period is actually just this portion. So, in other words, it's this subtracting this. So the term assurance for M plus N years subtracting the term assurance for M years. Okay, and this also equals VM MPX A X plus N with a line on top of that and a term for N years. So let's convince ourselves why this is true. Okay, so AX plus N, sorry, this should be M. AX plus M for N years refers to a term assurance contract for a life now aged X plus M for the next N years. Okay, and term assurance, I know because there's a line on top of the X plus M. So in other words, it'll discount the cash flows up until here. But my policyholder is now aged X. So I have to discount it by a further M years in terms of time value of money, and in terms of probability. So V to the M in terms of interest, in terms of the time value of money, and MPX in terms of probability. So this person must first survive M years, and I must discount it, the cash flow, by a further M years in terms of time. Okay, for money. All right. So that makes sense. And that's pretty much everything I wanted to cover in this video. So if you want to see me complete this life assurance contract section, then stick around for part 2.